Hello, in this lecture we're going to work some shorter test type problems that could be short enough to fit into a multiple choice type format. We have here on April 12th, company agrees to accept a 60-day 10% 5,300 note from J Company to extend the due date of an overdue account. What is the journal entry to record the transaction by the company? Okay, so we have an overdue account that we're going to basically say that we're not going to pay it, and we've agreed with the company to extend it the terms to make it into a note. So on our books, we had an accounts payable at this time, and we're going to transfer that payable to a note payable rather than pay it off at this time. The difference between the accounts payable and the note payable being that it's usually going to be for a longer period of time rather than 30 days. This period, it's going to be 60 days, usually a formal document instead of just a verbal agreement, and usually interest will be charged. So what that means is that we had an accounts payable, a liability that we need to take off of the books. So we're going to do the opposite thing to it. Accounts payable has a credit. We're going to debit the accounts payable for the 5,003, and then we have to credit something. And what are we going to credit? Well, we're going to put on the books now the new note payable. And so we're going to put that on the books, and all we did was take one liability off with a debit and put one liability on with a credit. The difference being this new liability now is subject to a 10% interest rate on it. Now, this is a pretty straightforward transaction. The thing that's a little bit tricky is that they give us this other information, the 60-day 10%, which will be needed to calculate the interest when we pay it, but it's not really needed when we make the transfer from an accounts payable to a notes payable, which we're doing at this time. Next one says that E is an employee who is paid monthly. For the month of January of the current year, she earned a total of $9,138. The FICA tax for Social Security is 6.2%. The FICA tax for Medicare is 1.45%. The FUTA tax is 0.8%, and the SUTA tax is 5.4%. Are applied to the first $7,000 of the employee pay. The amount of federal income tax withheld from earnings was $1,516.27. Her net pay for the month is what? We're going to round it. All right, so we're trying to figure out what the net pay for an employee is, and in so doing, we will have to calculate what the withholdings are for taxes. So we're going to start off with wages, and I'm going to put that in the outer column. These aren't debit and credits. I'm just going to put it out here so we can bring the withholdings on the inside. This is not a journal entry. And so we're going to say 19138 is what was earned. And now we're going to have withholdings, and the withholdings will include, now FICA, a lot of people think FICA is just Social Security. FICA includes Social Security and Medicare. The law of FICA includes Social Security and Medicare. So I'm going to say Social Security is going to be withheld. I'm going to indent that. There's going to be three. I'm going to highlight these three cells, home, alignment, and indent them to indent the withholdings. And we're going to calculate this, and we're going to say this is the 9138 wages times 6.2%. Now, if I move the decimal over two places, it's 0.062 if we write it in terms of a decimal. And there we have the 567. Now, I'm going to add decimals to all these. So I'm going to highlight all these cells and just at this time add the pennies, because when we're dealing with payroll, we generally want pennies in there too. So home tab, numbers, and I'm going to increase the decimal and add the pennies in there. All right, so then we're going to have Medicare, and that's going to equal the wages. Notice it's kind of like a flat tax here because it's a flat rate for the most part, times 1.45, which if I move the decimal two places over is 0.0145, and that's going to be the 132 there. And then again, they kind of threw us a curve here because they're talking about FUTA, and they give us the rate, and they get SUTA, and they give us the rate, and they tell us what the cap is on that. FUTA and SUTA are not withheld from the employee wages. Those are employer taxes we would have to calculate when we figure out the employer side, not when we figure out the net check. And then the federal income tax, notice the FIT, not our federal income tax that we pay on our federal income as the company, but the federal income tax that the employee pays on their wages. Notice it's not a flat tax. They have to give us the number, 1516.27, because it's a complicated process and we have to use a table due to the fact that it's a progressive tax to figure that out. So if we add those up or sum them, equals the sum of the Social Security, the Medicare, the FIT, total withholding for Federal income tax would be 2215. If those are the only withholdings, then the check after the federal income tax would be the check minus this withholdings, and the net check would be the 692267 after that withholdings for federal income taxes. Now note, again, if we wanted to figure out the other payroll taxes, our payroll taxes as the company, these are the taxes that are withheld. They're not recorded as payroll tax expense on our books. The payroll tax expense would be our half of the, as the employer of the 6.2 Social Security, our half of the Medicare 1.45, and then we'd have to include the FUTA, which is only an employer tax, the SUTA, which is only an employer tax. That would be the payroll tax expense side of things. Next one says that a company's fixed interest expense is $20,000, its income before interest expense and income taxes is $140,000, its net income is $58,800. The company's times interest earned ratio is what? So if we're trying to figure out the times interest earned ratio, what we're trying to do is figure out how many times over we could pay the interest on a particular debt, given basically kind of like the net income. And so what we're trying to do as a loan, if we're trying to give a loan, we're trying to say, okay, at least we want them to be able to pay the rent on the loan, the interest. How many times over could they pay that? That'll give us some idea of how secure our loan is. So in order to do that, though, we don't want to take net income. We usually, because we don't want to include the expense of interest when we're trying to figure out how many times over they can pay the interest. So we need to pull that out of net income. And we also don't usually include the taxes, because the tax expense, because that distorts things as well. So we just kind of take that out when we're doing these estimates. So normally we would have to take net income and pull out the taxes, pull out the interest expense, then take the net income without those things and divide it by the interest expense to see how many times over the interest could be paid. Now, in this case, it's kind of tricky in that they gave us the number without interest and expense. It says income before interest expense and before taxes. So instead of having to back that out, they just gave us that number. And then they gave us this other number, which we don't really need. And that's kind of the tricky thing of multiple choice questions. We're going to be questioning whether or not why did they give us that number. But the interest expense is $20,000. So if we're trying to see how many times over we can pay the interest expense, given the net income without taxes and without interest expense, we would take the 140 divided by the 20,000. And I'm going to add decimals just in case they're already home tab numbers, add decimals. So we could pay it 7 times over. So if nothing else, at least we can pay the interest if we don't have to pay the principal back or anything, and we could pay the interest 7 times over. Next one says that employee earns vacation pay at a rate of 1 day per month. During the month of July, 28 employees qualify for 1 vacation day each. The average daily wage is $103 per day. What is the amount of vacation benefit expense to be recorded for the month of July? So this one's pretty straightforward. The tricky thing about the vacation pay is, of course, that we are going to record it as the vacation is earned. So that means that we're paying for the vacation basically as it's earned, not when the vacation was taken. And we have to use this estimate to do that. If we understand that, then it's a pretty straightforward calculation. We got the number of employees is 28 employees. And they get one vacation day per month, so obviously times 1 would just be the same 28 if we multiply that out. And we're averaging that each vacation day, they got 28 of them now because they got 1 day for each employee and there's 28 employees. And we're saying that it's going to cost about $103 per day that they have earned. So at this point, they have earned those days, and therefore we are going to record the 103, so at this time. So we got the 28 times the 103. That means that amount of vacation benefit expense at this point in time would be the 2884.